After listening to a couple hundred Rick Rule speeches and interviews, these are some of the best ways to guarantee that you lose money investing in mining stocks. As always, it's worth noting that this isn't investment advice, and always do your own research before making any investment. One way to lose money is to not know the company well enough to know what could go wrong. I've heard Rick say that if you don't know at least 3 things that could go wrong with the company, you don't know enough to invest in the company. So make sure you study up on it so you know what you're putting your money into. The next great way to lose money is to invest in those companies where the top management doesn't own much stock. If they don't own much stock, they're not going to be aligned with you, the shareholder, and they're going to be acting in their own self-interest, often like making sure they continue getting paid their salary rather than acting in the shareholder's best interest. The next way that Rick says you'll lose a bunch of money is if you do what a lot of people do, and that is got a hunch, bet a bunch. So just think about how much research you do when buying some consumer good. So for example, right now I'm shopping for an electric razor because, as you can see, I need one. So what have I been doing? I've been reading reviews from other people. I've been comparing my options, comparing the features, things like that. And in addition to that, like after I've decided which one that I want to get, I'm patiently wait for a sale or shop around to try to get the very best price. Compare that to what we do when we go on YouTube and we hear a hot stock tip from some mining stock monkey. We go and put $5,000 in it that day without researching it at all. Now, I'm not just like criticizing here because I've done this myself. It's stupid, but I've done it because you hear something and it sounds really good and you're like, oh, I need to buy that. It looks like such a great price. And then you get screwed and you lose money because you weren't patient and you didn't research enough and you didn't invest enough of your time into that decision. So if you're going to put a few $1,000s into a stock, make sure you do enough research to make sure that that's a good investment for you. If you want to lose money, something else you can do is to buy a stock or buy a sector after it has gone way up in price. For example, recently lithium shot up in price like crazy. Tons of people piled in at the top, and now they've lost their ass as the price of lithium has collapsed over the past little while. So this is a very cyclical industry. There's the highs and there's the lows because high prices cure high prices and low prices cure low prices. What's the reason for that? Because like when the price of lithium goes up, for example, people start to try to find substitutes for lithium, so they start using less of it. And also as the price goes up, there's going to be less demand because not as many people can afford it. And in addition to that, the higher prices incentivize more supply. More supply comes online and pushes the prices down. And then the opposite happens when prices are low. This is a very cyclical industry with huge oversold lows and then way overbought tops. And it's the perfect opportunity for a contrarian to come in. Because if you can come in and buy those lows and sell those tops, it's a very inefficient market and it's a way that you can make a lot of money. As Rick says, be a contrarian or you will be a victim in this sector. Another great way to lose money is to invest in those companies where management didn't do what they said they were going to do. So let's say they raise $5 million to drill their deposit that they have, to find out more about what's under the ground there. And then they end up spending that money on something else. If that happens, well, maybe it's a good idea not to trust them with your money in the future. This one is counterintuitive, especially for the newbie. But another great way to lose money is to buy when the price to earnings ratios are super low. Like in the general market, it's typically a good idea to buy when the PE ratios are really low. However, here in this cyclical industry, the PE ratios are the lowest when the prices are the highest. For example, a couple of years ago, the price of palladium went crazy and it was way up here in the stratosphere. And those companies producing palladium, like Impala Platinum and Sibanye-Stillwater, they had ridiculously low PEs. I forget exactly what they were, but I think it was around 3, a PE of 3. It looked on the surface like a really good investment because, oh my gosh, I'll get my money back in 3 years. But then the inevitable happened and the prices of palladium crashed. And now in the past 2 years, Sibanye-Stillwater is down 75% and Impala Platinum is down 80%. So that's why it's generally a bad idea to buy when the PEs are super low, because that typically means the commodity prices are really high. Because as we learned earlier in this video, in this industry, high prices cure high prices. By the way, if you're finding this video helpful, please click that like button because it helps me know that I should make more videos like this one. The next way to lose money is to hold on to a stock after the thesis that you originally had has failed. Once that thesis has failed, it's time to get rid of the stock regardless of the price. So you buy a stock hoping for good drill results, and then the drill results come back and they're terrible. At that point, your thesis, the good drill results, has failed, and it's probably time to sell the stock. Yes, the stock will be down, but you still have to get rid of it if your thesis has failed. In one interview, Rick was talking about a former client of his, and he was going through the portfolio that this guy had, and he's like, okay, why do you own this stock? Oh, it was a recommendation from this guy years ago. Okay, what do you know about it? Nothing. And he's like, okay, sell that. And the client's like, no, we can't sell that. And Rick said, well, why not? Oh, because I'm way down on it. I'm down like 80 or 90%. And if I sell it, I'll lose that money. And Rick said, no, you've already lost that money, but the question is, what are we going to do with the remaining money? So in the world of investing, if the average stock goes up 10% a year, that's the beta. But the alpha is what you can get above that 10%. And the next way to lose money is seeking that alpha without dedicating an appropriate amount of time to researching those companies. If you don't have that time to dedicate to researching those smaller companies where you're less sure about what the results are going to be, maybe it's better just to take the beta. Like, let's say you think gold is going to go crazy in the next few years. Maybe you just want to get the beta by buying the biggest and the best stocks. And in a bull market, those biggest and best stocks, well, they have a lot less risk in any market, but anyway, in a bull market, you're still going to get substantial returns for that. So a lot of times, just sticking with the biggest and the best might be your best option. Another way to guarantee that you lose money is to sell just because the stock price went down. Now, a lot of times the stock price goes down for legitimate reasons, but then a lot of other times, especially in this sector, the stock price is way down 50%, even 80%, just because sentiment is bad, or just because the metal price has gone down a little bit. So there can be drastic swings in the stock price. And those times, assuming nothing bad has happened with the company or there's no major flaws with the company, those times of low prices should be considered sales and a time to buy more. Like Rick says, when you go grocery shopping and that tuna is half price, you buy a lot of that tuna because you're getting a good value there. And you might not get that value for a while, so you want to stock up. By the way, my name is Jordan and I've been a mining stock investor for the last 17 years. If you would like to know what I'm doing personally with my own money, go to miningstockmonkey.com and sign up for my free newsletter. The next way to lose money is by disregarding environmental and social factors. The last few years, ESG has been all the rage, but the mining industry has known about ESG for many decades because we know that if we don't have the support of the local people, if we don't have the support of the indigenous people, that mine is not going to get built. So it's really important that the company is seriously engaging with the local community. Now, every one of these companies on their presentation will have like what they're doing for ESG, but I mean, a lot of them is just BS, but you have to make sure they're engaging with the community the right way to ensure that that project can move forward with the local support. Another great way to lose money is to have a time mismatch between your personal expectations of how long you're willing to wait before the stock price goes up versus how long it's realistically going to take to get a re-rate in the stock. So let's say a company is going from a developer into a producer. So they're in the phase of building their mine. And that mine build is going to take 2.5 years. And you have an investment time frame of 3 months or 6 months. That's a totally unrealistic investment time frame because to get the whole value out of that build, you need to be willing to wait those 2.5 years and maybe even a little bit longer to account for any delays. So if you're pissed because your stock price is down after 6 months and that mine build was going to take 2.5 years, that's not the company's fault. That's your fault for having unrealistic expectations. Your expectations have to match reality. And I get that it's hard to be patient sometimes. Sometimes you just want it to happen faster. But what you want, as Rick says, does not matter. Another excellent way to lose money is to invest based on narrative instead of based on value. So if you invest based on narrative, what other people are saying, oh, this is so great, everybody's making so much money, well then you're going to be investing near the highs of the cycle, and then you're preparing yourself to lose a lot of money as you go into the lows. But on the other hand, if you invest based on value, you can look at a company and be like, hey, this company is selling for $30 million, but I think it should be worth $150. So I'm going to invest in this company at a $30 million valuation, and I'm just going to sit here patiently and wait. That's going to make you a lot more money than chasing that narrative, because chasing that narrative typically gets you investing at the top of the cycles, which is a great way to make sure you lose money. So if suddenly, for example, silver becomes super hot and everybody you know is talking about silver and how everybody's going to make so much money investing in silver, well, that's a great sign that it's time to take some money off the table. And because you were invested in value, your bets were already placed on silver before the mania happened. Another way to lose your investments is by not being financially and psychologically prepared for massive declines in your stock prices. When you're investing in a super volatile sector like this, you're going to get 50% drops in your stock prices pretty often, unless you're investing in just the biggest and the best companies. But if you're going down the quality trail at all, you're going to have those massive drops in price. So make sure you're mentally prepared. Thanks for watching, and watch this video next. It's 17 of Rick's best tips to make money in gold and silver mining stocks.